edition of the Latin America Policy Dialogue webinar series here organized by the Economics Department of the OECD. This series is about bringing together experts, policymakers from around the region to discuss topics of common interest. Today, we'll be focusing on the economic impact of fast payment systems in Latin America. As everybody knows, these payment systems, along with digital walls, are transforming the financial landscape in many countries in the region. They're facilitating financial inclusion and also payments more generally. We have a great lineup of speakers here today. Renato Gomes, Deputy Director of the Brazilian Central Bank. Renato is responsible for the PIX system that has been so much talked about as a successful experience in the continent. Also have Cristiana Costa, who is the Chief Product Officer of DaviPlata, a digital wallet and fast payment system of Colombia. We have Sean Higgins, Associate Professor at the Kellogg School of Management, Northwestern University in the US. And last but not least, my colleague Tomás Meyer, who is a policy analyst at the OECD Financial Consumer Protection Unit. We'll be exchanging over the next hour about the design and rollout of fast payment systems and digital wallets in Latin America. We'll be discussing their impacts on economic inclusion, on the potential that those systems have to support formalization in labor markets and improve tax compliance, among other policy objectives. We'll also be talking about the institutional and regulatory frameworks that are being and need to be developed around those systems to make sure that they meet their full potential. Each speaker will have about 10 minutes to make a presentation. That should leave some time at the end of the presentations for exchanges among panelists and with those of you who are accompanying us today. We'll be collecting comments in the chat so that we can then convey those to the panelists. Let me remind you that this will be recorded essentially for internal purposes here at the OECD. So without much ado, given that the time is limited, could I invite you, Renato, to take the floor and make your presentation?
Okay, so thank you so much. If we could upload the slides, please. Good morning and good afternoon or good evening for those who joined the call. And I would like to thank Luis for organizing this great webinar. And it's truly an honor to share insights with such a distinguished panel and an outstanding audience. So I understand that my job here is to give an overview of PIX, which is the Brazilian fast payment system. So if you let me, I would like to start with some history. So in 2013, we approved in Congress a landmark law that granted the central bank oversight over the Brazilian payment system. Before that, we had no regulator for payments here. And with this new mandate, and quite parallelly to what Europe did with PSD1, we created a new entity, which is the e-money issuers that can offer payment accounts, but they cannot grant credit. So these institutions, they operated digitally, basically with cell phones, so bank apps, and therefore they avoided the legacy costs that traditional banks have, and they could offer accounts for free while generating revenue from interchange fees from cards that they would issue to their clients. So this model, which is much leaner than the usual bank model, spurred a lot of competition in the Brazilian payment and financial sector, with new players entering the market and providing real alternatives to traditional banks. Some of these institutions, they later pursued additional licenses to offer credit, effectively functioning as, let's say, synthetic banks. Okay? So examples include Nubank, which is said to be nowadays the largest fintech of Latin America. We have Mercado Pago, which is the payment branch of Mercado Libre. In Brazil, we also have PagSeguro, PicPay. We have many such institutions. However, before Pix, in a sense, the fintech sector faced challenges. And I think one main challenge is that for consumers, switching from traditional banks was difficult because cash was still king. And incumbent institutions, they were actually experts in dispensing cash because these incumbent banks, they had a large ATM network and a large branch network. And ATMs in Brazil, they are not fully interoperable. So effectively, these large branch networks, they consisted of an important barrier to entry. It was a really competitive advantage for incumbents. And indeed, in 2019, 1 year before launching Pix, we ran a survey and learned that cash was still the payment mean in 87% of transactions carried out by citizens who earned at most 2 minimum wages. Whereas this number dropped to 41% for those citizens who earned at least 10 minimum wages. So we see that the use of cash is very correlated with income. Okay, so overcoming this digital divide on the use of payments was one of the main reasons for developing Pix. So it was really needed for financial inclusion reasons to bring digital payments to the entire population, notably to the low-income segment that was typically excluded from the financial system. So before actually stepping in, the central bank encouraged the private sector to come up with a fast payment system. But that didn't happen, and that's understandable because sometimes it's difficult to overcome the collective action problems that developing a fast payment system entails, right? In a sense, not all actors had the right incentives to do so, especially because they had many rents coming from, let's say, the outdated payment system that was still prevalent. And actually creating a fast payment system from scratch, it requires quite complex coordination and standard setting activities. And also, I believe that the need for an open architecture that's fully interoperable and coupled with an unbiased governance, these are features that fail to thrive naturally under private provision. So for these reasons, the central bank decided that an instant payment system should be part, in fact, of a broad public policy agenda. And it was also decided that the underlying infrastructure of this fast payment system should be provided as a public good. So to be clear, Pix is a payment scheme of which the central bank is the scheme owner, therefore is the one who sets the rules, right? And it's also the operator, settling payments on a real-time gross settlement basis. So this slide, it very much describes, let's say, key principles that guided Pix development. One is that mandatory participation from institutions with at least 500,000 accounts. So the idea to make mandatory from the beginning for these institutions was to make sure that essentially all Brazilians with a transactional account had access to Pix from day one. So that generated quite strong network effects for peer-to-peer transactions. Okay, of course, once you have network effects on peer-to-peer transactions, it was much easier to attract merchants to the system and therefore to grow the P2N sector. Okay? And Pix is, of course, for those institutions who are not mandated to participate, Pix was open to both banks and non-banks. Okay, so it was essentially very inclusive for most institutions in the Brazilian payment and financial sector. Another important feature of Pix is that we have Pix keys, as we call them, which are simple aliases such as the email, the phone number, the tax ID that people can use to identify the payee, right? And we also standardize QR codes from day one. So Pix QR codes are standardized across all institutions that participate on Pix. We also cared very much about user experience. So we standardized Pix branding and the user interface across financial institutions. So no matter the institution that you have, inside the app of that institution, the interface for using Pix, the logo, the fields that you have to fill, everything is standardized. So consumers, they see a common Pix, which reinforces trust in the system. And another key feature is that Pix was from the start integrated with existing banking apps. So users, they didn't need to download or register to anything additional to what they already had. So Pix was embedded in the existing banking and financial service apps. That, of course, implies that there is built-in security in that the existing security measures of these apps, they were immediately inherited by Pix, and so from the start we have high levels of security. And there is also important features regarding accessibility and cost efficiency. So we mandated that transactions between individuals would be for free, whereas transactions P2M, they could be charged to merchants. In reality, they are free for most merchants precisely because of competition among the institutions. But there's nothing that prevents merchants from being charged. So in a sense, the structure of incentives that put forward, it solved the chicken and egg problem that's so crucial in launching a payment system. If you could move to the next slide, please. Another key feature of Pix is the governance. So Pix has an open governance, and the development of the rules and essentially of all functionalities is something that is very much debated with the market. So I think one crucial ingredient of Pix is that we care tremendously about the business case behind the new functionalities and behind the system itself. So we have something that's called Pix Forum, which is an advisory committee that essentially consists of all participants and also civil society and also all types of payment institutions and stakeholders to discuss how the system should evolve so that everybody's contemplated and people have business models to work on. Okay, so if you could move to the next slide, please. And so adoption of the system has been quite rapid. In the beginning, Pix was essentially a P2P system. More than 90% were P2P transactions, whereas nowadays it's very much balanced between P2P and P2M, as you can see in the graph, and the right hand graph is also displaying the number of individuals using Pix among the adult population in Brazil, and that now has reached close to 90%. Right? And Pix also is the primary payment method for micro entrepreneurs and small business. So that's something that was crucial for the expansion of financial inclusion. Looking ahead, we continue to evolve the Pix system, and I would like to highlight 3 initiatives that should be very much at the focus over this year. One is what we call Pix Automático, which is recurring payments on Pix. So we are introducing solutions for automated scheduled payments, such as subscriptions for, let's say, streaming services or utility bills or the gym whatever. So all types of companies, small and large, that have recurrent bills to send to consumers, they can use PIX and do that in the safest way, both for the firms and also to consumers who can follow the details of each transaction. We also have a new product that's going to be called PIX Installments, which will be a standardized buy now, pay later solution integrated with PIX. And we are also working on a cross-border functionality to enable, let's say, seamless international payments through the PIX system. So that entails talking and very much collaborating with the multilateral initiatives that aim at integrating various fast payment systems. So to conclude, I believe that the success of PIX underscores the power of an inclusive, open, and efficient payment infrastructure offered by the central bank. And I believe it demonstrates that a well-designed public infrastructure can drive meaningful change, fostering a more inclusive and competitive financial system for all. So thank you.
Many thanks, Renato. Very interesting. Thanks for scanning the horizon. On PIX, very interesting points about how you build the trust around a new initiative, a payment system, and create the conditions for it to not only to take off, but also to develop through use and through the creation of networks, not that then keep the system functional. Let me turn to Christian, moving further north in the continent to hear about the experience of Colombia. Christian, the floor is yours.
Thank you, Luis. Thank you, everyone. Okay. Well, hello, everyone. It's a pleasure to be here. My name is Cristian Acosta. I'm based in Bogota, and I've been the Chief Product Officer of DaviPlata at Banco de Vivienda for the past 2 years. I have nearly 20 years of experience in the Colombian financial sector, and today I'll be sharing you a little bit about the 12-year evolution of DaviPlata. Next slide, please. Well, what is DaviPlata? DaviPlata as a product is a low-value deposit product operating as an independent unit within Banco de Vivienda. Within that unit, we have developed a neobank, a 100% mobile digital wallet that is accessible to all Colombians over 18 years old. Next, please. DaviPlata was a pioneer in Colombia, launching in 2011 with the purpose of providing Colombians with access to a completely digital financial service that allowed people for easy, secure, and free money movement. That was a huge disruption in the market because everyone was charging for fees for transactions. So we created a 100% free product and still remains that way. As you can see in this chart, we have experienced significant customer growth. We're currently serving 18.5 million customers. And of course, the pandemic significantly accelerated the digital adoption in the country, propelling DaviPlata from 6 million customers to nearly 12 million customers. We duplicated our customer base during that time. And throughout our history, we have processed over 4.5 trillion transactions, totaling more than $41 billion in cash flows through these years. Additionally, our customer base includes 2.4 million small businesses, which are the cornerstone of the country's economy. We estimate that we have around 8 million small businesses in Colombia, people without formality in their businesses, and they definitely use these kind of solutions. Next one, please. Okay, now let me give you a brief overview of the journey where innovation has been central. That's one of our core values. In 2011, DaviPlata began as a SIM-based messaging service. It was available to all Colombians with minimal data requirements. We just need three data from our customers. And it quickly became a tool for distributing government program funds because we were available to everyone. Yeah. Everyone with just a cell phone could register it and use the product. By 2012, we were establishing a network of banking correspondents because we needed to deliver cash across the country. And then we also started fostering cashless economies. We created something called Cashless Village, where we went to a couple of populations in Colombia and tried to challenge them to live without cash. So we did a couple of experiments, and we have around 5 ecosystems in the country. In 2016, we launched our mobile app, which later introduced features like social media payments. We also integrated a button for e-commerce that is available here in Colombia called PSE or PSE. We also developed an e-card with MasterCard, a prepaid card, and we began to enter in physical payments with QR code reading. That was a closed loop QR, and also with POS payments. So we enable our customers to buy online and offline around 2016, 2017. Then in 2021, we entered the world of open finance. We created a virtual store where we sell different products, not just financial. And we also created a partnership with the Medellin Metro, with the Metro system. We have an application there where people can generate a QR code and access to the Metro system, or recharge their card to the Metro. We have almost 1,800 users there. And we also created an alliance that I think you heard about with Rappi, and we created RappiPay together. We also launched our payment API that's installing almost 160,000 merchants in Colombia. Next one, please. Well, Colombia faces a considerable challenge in transitioning to digital transactions. Although 94% of Colombians have access to financial products through DaviPlata or through Nequi, which is the other digital wallet in Colombia. We have a lot of options, but those two are the main ones. So 94% of Colombians have access to a product, but almost 80% of transactions are still cash-based. The average daily payment in Colombia is $15 per person. It's kind of small, but cash remains king. Cash is still the king in all of transactions. We can see that debit card payments have increased to 6% of market share, and instant transfer have definitely helped changing this market. And they have emerged as a strong second option, capturing 14% of the market. Next one, please. Now, the instant payment systems have been active in Colombia for almost 5 years as private initiatives. The first significant initiative is called Transfilla. It's provided by the ACH provider here in Colombia, and it has been around 5 years in the air. It has handled nearly 70 million transactions this past February, and for the past 3 years, another solution appeared in Colombia by another provider called Redevan that has offered an interoperable instant payment service with QR codes. So Transfilla is for only digital transactions using the cell phone number, and Redeban created a QR code that is displayed in almost a million merchants in Colombia. Monthly, over 2 million DaviPlata customers use Transfilla, the first system I was telling you about, and more than 300,000 people use the QR code payments in stores and small merchants. So this has been a transformation for the past 5 years in our ecosystem. In 2024, instant transfer, both system, reached $2 billion, and the QR code reached $50 million. So this is something that is growing in the market. But as I told you previously, cash remains king, because we have some tax systems for the movements in the accounts. So that's a huge barrier in Colombia. Next one, please. So now this year, we anticipate the launch of a new instant payment system created and sponsored by the central bank, and is based on Brazil's PIX that we were listening about. Regulations have been changing in Colombia. We have new regulations for open banking, for open data, and this new regulation for payments was issued last year. But we were working together, the whole industry, for almost 18 months previously. So we have these new regulations. But as I was telling you, the Colombian context differs greatly from Brazil's. We have already 2 successful free instant transfer systems, as well as we have an established online payment solution, the button that I was telling you previously. So factors like the financial transaction tax is a significant hurdle to digital payment adoptions. So this new system is going to be called Breve. It aims to create a unified user experience where banks and non-banks have to unify our user experience across all of our applications. We're going to be using data keys for transactions. We only use the cell phone in Transfilla. So now we have many options. We have the ID, the cell phone, email, or codes issued by the institutions. So one large challenge will be the education of the clients, because these new key systems can be a little bit confusing, because we were using just the cell phone, now we have many options. So that's different from what we do today. So the key registration in the new systems will begin this July, and will begin transactions in September. We have, as DaviPlata, actively participate in the design and development of this system, as well as its predecessors, and we're optimistic about its success in Colombia. Next one, please. And that was it. Thank you so much for your attention, and I'm happy to answer any questions you may have.
Many thanks, Christian. Interesting to indeed compare and contrast the different experiences now with Brazil before, given the pre-existing systems that you already have in place in Colombia. And also interesting point, an important one that maybe we'll come back to later on as potential deterrents to the development of those payment systems arising from the tax system, the presence of the financial transactions taxes, as that you mentioned, as one of them. Can I invite now Sean to take the floor?
Excellent. Well, thank you so much for including me on this panel. Very excited to be here. I'm going to present on payment technologies and financial inclusion. So why do payment technologies matter? Well, as we've seen, new payment technologies are rapidly changing the way that households shop, save, borrow, and make other financial decisions. And payment technologies can benefit both the demand and supply sides of the market. So on the demand side, consumers benefit from lower transaction costs, which you can think of as costs of sending remittances, costs of traveling to a bank or the crime risks of carrying cash. And on the supply side, retail firms benefit from a reduced risk of cash theft and by attracting consumers who prefer not to use cash. And just in case you think this last point about attracting consumers who prefer not to use cash is not that salient for small retail businesses, here's a picture of a corner store that has painted very prominently above its doorway, "We accept all credit cards." So what I'm going to talk about today is based on a paper of mine called Financial Technology Adoption, Network Externalities of Cashless Payments in Mexico, that's published in the American Economic Review. And then I'll also briefly talk about other work in fast payments at the end. So what do I look at in that paper? Well, I look at when debit cards were given to cash transfer recipients. These are poor households who receive conditional cash transfers from the government in Mexico. And these households were already being paid their transfers from the government in bank accounts. But before receiving a debit card, they had to travel to the nearest bank branch to access their cash. With the debit card, they could access their money at any bank's ATM, or they could use their debit card to make purchases at stores that had a point of sale terminal to accept cards. But you get stuck in this chicken and egg problem that Hanatu mentioned as well with Pix as a potential friction, where at the time, a lot of the stores where these people shopped didn't accept card payments. Now, of course, debit cards and POS terminals are an older payments technology. So why am I spending my time on this panel about all these new technologies, these new fast payment systems, talking about an old technology? Well, I think it has lessons for how fintech payments technologies can increase the use of financial services and savings, and also two-sided payment markets where you get this chicken and egg problem where you both need consumers to adopt cards in this context and you need businesses to adopt technology to accept cards are very relevant for fast payment systems, as Hanatu had mentioned in the case of Pix. So to give you a sense of what adoption looks like on the two sides of this market in Mexico, or what it looked like at the time, here I'm showing you on the x-axis the number of debit cards per person, and on the y-axis, the proportion of retail stores with a point-of-sale terminal. And I'll show you how that evolves over time. Each dot in this graph is a municipality, and the size of the dots represents the population of the municipality. And you can see that over time, these dots are mostly moving up and to the right, so adoption is happening on the two sides of this market more or less simultaneously. We can also look at what that looks like over time and space. And so here what you can see is that in the areas that tended to have high levels of adoption on one side of the market, that's correlated with high levels of adoption on the other side of the market. And then if we look at how that changed over time, you can also see that the areas that tended to have a high increase in adoption on one side of the market tended to have a high increase in adoption on the other side of the market. So in this project to measure the impacts of payments adoption, I exploit that gradual rollout of debit cards over time by the government in Mexico. What did that look like? Well, over 2009 to 2012, Mexico's conditional cash transfer program Prospera distributed about 1 million debit cards in urban localities, which are localities with a population of at least 15,000 inhabitants. Before the intervention, before the debit card rollout, these urban recipients of the government cash transfer program received their transfers in a bank account at the government bank known as Bansefi, and they were paid every 2 months about $150 on average. That was their transfer. Once the intervention happened, they continue receiving the same payments every 2 months, but they now have a Visa debit card attached to their bank account. And they can use that card to withdraw funds from any bank's ATM or to use it to make purchases at any store that accepts Visa payments. This is what the rollout looked like over time. And every time you see a big increase happening here in this graph in terms of the number of debit cards they've distributed to cash transfer beneficiaries, that's the government distributing in particular localities, giving cards at the same point in time to all of the cash transfer recipients in that locality. And then what they did is they went to different localities at different points in time. So you can see that here in this map. One thing to note here is that they wanted the administrative outcomes, such as how easy is it to get cards to people, to be representative of how it was going to be at different stages of the rollout. And so, well, they didn't explicitly randomize the rollout. They did want a quasi random sample at each stage of the rollout. So if you take, for example, 2010, you can see there's green dots all over the map. It wasn't like they were starting in the center and then spreading out from there or following some other geographic pattern. So now getting into the results, what was the impact of distributing these debit cards? Because in this two-sided market, you can think of this as a large shock to the fraction of people who have debit cards. And that can be what gets you out of this chicken and egg problem when you're stuck in a low adoption world. Having a large coordinated shock on one side of the market where a bunch of consumers adopt at the same time can then push you to a higher adoption equilibrium. So what we can see here is that this is showing you before and after the debit cards were distributed in a particular locality compared to other localities that will also receive debit cards but had not yet received debit cards. What's the number of corner stores that have a point of sale terminal? And you can see before the cards were distributed, there's no differential trends in the number of corner stores that have adopted point of sale terminals. Immediately after they distribute cards, you see a small increase, about 4% more corner stores adopt point of sale terminals in the first 2-month period after the cards are distributed, and that gradually increases over time. About 2 years after cards are distributed, you have about 18% more corner stores with point of sale terminals. Now, if we look at the effect for point of sale terminal adoption by supermarkets, you see no effect. Now, that's not surprising because supermarkets already had near universal adoption of point of sale terminals, but corner stores, the one I just showed you, is where people are doing most of their shopping in Mexico. About 50% of all retail and restaurant consumption is concentrated at corner stores, and another 25% is concentrated at supermarkets. And then the other 25% is concentrated at other types of stores where you also did not see an effect of this debit card shock on adoption of point of sale terminals. Now moving back to the demand side of the market, back to consumers, we can look at whether this increase in adoption of technology to accept card payments on the supply side of the market led to increased adoption by other consumers, not the ones who directly received cards from the government. And we see that indeed, after the debit card shock, other households are increase their adoption of debit cards by about 21%. There's another type of spillover onto other households, which is that they shift their shopping patterns across stores once these small corner stores start accepting card payments. So here you can see the change in consumption at different types of stores. So at corner stores, you see that among richer consumers, among the top 40% of consumers based on their income, they shift about 13% of their consumption from supermarkets to corner stores once the corner stores accept card payments. And that's coming at least in part from a shift in the number of trips that they make to each type of store. So you can see that those richer households who mostly already had cards are shifting are making 0.8 more trips per week to corner stores once the corner stores accept card payments, and they're making 0.2 fewer trips per week on average to supermarkets. Finally, what effect did this have on these corner stores? Well, now that the corner stores are getting more customers coming in and more spending at their store, unsurprisingly, you see an increase in the corner store sales. Now, they also, if you look at the various costs of the corner store, their inventory costs increase because they're buying and selling more inventory. They're turning over more inventory, but they're able to do that without an increase in other input costs, such as wages, rent, capital, and utilities. And so that leads to an increase in their profits of over 20%. And then going back to Luis's comment about formality, we also see an increase in the fraction that are formally registered, and I don't have it here, but I have it in the paper. You also see an increase in the total amount of value-added tax payments, and also if you take value-added tax divided by sales to see whether they're kind of increasing the proportion of tax they're paying relative to their sales, you also see an increase there once they've adopted point-of-sale terminals. So to end, I wanted to point to some of the other research out there on newer payment technologies, on fast payment systems. So there's a few other benefits that have been found. First, lenders can use payment transactions to evaluate creditworthiness. There's studies finding that this is being done in India with their UPI fast payment system, that this is being done in Brazil. And I also have work showing that this works well even for borrowers with no credit history whatsoever. So they have no formal credit history. You can use just that payment transactions data to get a good indicator of their creditworthiness. These fast payment systems can also lead to increased bank account ownership and complementarities with other payment technologies, such as debit and credit cards. So my PhD student, Matteo Sampaio, has work on that. And they can also lead to lower bank market power and higher deposit interest rates that benefit consumers and depositors, because now people have an easier time moving their money across banks, so they can try to take advantage if banks are competing to offer better deposit rates. Thank you.
Thank you very much, Sean, and thanks for illustrating the variety of benefits that are associated with the type of experience that you illustrated from Mexico, that sometimes are unintended, desirable, but unintended consequences of the original design of policies in this area. So very interesting, and I hope the literature will continue to explore some of these benefits so that we can have a broader view of what can be achieved through an intervention that is much simpler than other programs that try to achieve the same objective. Can I invite you, Tommaso, to take the floor?
Hi, everyone. Thank you for the opportunity to speak on this topic. So I'm Tommaso Maier, and I work at the Financial Consumer Protection Education Inclusion Unit at the OECD. The key message here from me is, can you please stay in the previous slide?
Yes.
Thank you. Key message here for me is that digitalization of financial services, particularly payments, present opportunities for financial inclusion, but also significant challenges. Thanks to digital payments, financial inclusion has increased substantially worldwide. For instance, in LAC countries, the share in individuals making or receiving digital payments rose from 46% in 2017 to 66% in 2021. However, vulnerable segments of the population, such as the elderly, youth, or those with low digital and financial literacy, face increased risks. And this highlights the need to focus not just on access to financial services, but also on overall financial well-being. So in my presentation today, I'll briefly cover the financial well-being framework we developed together with the G20, some of our work highlighting risks arising from digital payments and related regulatory and supervisory responses, and some key highlights and some key insight on digital financial literacy. Next slides, please. So let me start with financial well-being, which in recent years has gained an increasing attention. This is because simply having access to financial services is not enough, and it's evident that we need to focus on individual outcomes of financial education and inclusion policies to ensure that access to and use of financial services are beneficial to people. So in the report that you see referenced here, we have a working definition of financial well-being, which refers to a state in which individuals are able to smoothly manage their financial needs and obligations, can cope with negative shocks, can pursue aspirations, goals, and capture opportunities and feel satisfied and confident about their financial lives. Financial well-being depends on many factors, such as access to quality financial products, digital financial inclusion, financial literacy, and policies in this area. Policy in financial inclusion, consumer protection, and education all play a role in shaping these factors to improve how these factors improve financial well-being. So key point is that access alone does not guarantee positive outcome. Consumer needs to be empowered and protected. Next slide, please. So turning to the importance of effective financial consumer protection framework. So We have the G20 OECD principles on financial consumer protections, which are the international standards in this area, and they are under the responsibility of the Working Party on Financial Consumer Protection, Education and Inclusion. So as you can see from the slides, the principles set out the essential elements of financial consumer protection, taking into account a holistic approach, and they cover everything from legal, regulatory, and supervisory framework to the role of oversight authorities, transparency and disclosure, fair and equitable treatment of consumers, responsible business conduct, protection of consumer assets, and complaints handling. The principles were updated in 2022 with 3 main updates: the addition of 2 new principles on access and inclusion and quality financial products, the inclusion of 3 cross-cutting themes, including digitalization, and the incorporation of lessons from the response to COVID-19 pandemic. Next slide, please. And the principles specifically address the impact of digitalization. And we have published, here you see some of our work, especially on digital payments and risk arising from digitalization. One of the key piece of work that we carried out is the OECD Consumer Finance Risk Monitor, which tracks risks and trends affecting financial consumers and draws insight from policymakers and supervisors from over 40 jurisdictions. Relating to digitalization and digital payments, the risk monitor identifies several concerns, and one of the key ones is about financial frauds and scams. For example, 72% of jurisdictions reported an increase in the incidence of frauds and scams in their jurisdiction. Another key concern is the lack of digital capability of consumers when using these products, and the lack of access to cash and physical banking services. You see here also reference a report by FinConnect, which is a global network of financial consumer protection supervisory authorities, and our team also supports FinConnect. And in 2022, we published some work examining specifically the risks linked to the rise of digital wallets and fast payments. This work was based on input from supervisory authorities in 18 jurisdictions, including 2 LAC countries. Again, one of the most pressing issues here is fraud and scams linked to digital payments. And the concern is that instant transactions may make it harder for consumers to detect and reverse fraudulent transactions. The most vulnerable groups identified and subject to frauds and scams include seniors, retail investors, and immigrants. And this is also associated with an increased risk of unauthorized transactions and account takeovers, often using stolen credentials and social engineering tactics. More generally, respondents also highlighted an increase of security incidents related to digital payments. And they also highlighted another concern, which is represented by inadequate consumers' digital capabilities. This is quite important, as individuals may not be aware of the risks related to the use of these financial products. Another concern identified in the report was that new market players may be unfamiliar with laws, regulation, and guidance governing digital payments. So the report also looks at what the financial supervisors do to address these challenges. These steps to address these challenges include the strengthening consumer protection framework, ensuring that payments providers, for example, implement fraud prevention tools, have appropriate liability arrangements in place, and clear redress processes. Supervisors also have been mandating strong authentication measures, such as multi-factor authentication, to reduce unauthorized access risk. And they have been imposing low-value limits on digital transactions, for example, on contactless payment without strong customer authentication, which which is where risks are higher. And they've also been promoting financial education to help consumers recognize scams and protect their accounts. At the moment, we have some major work ongoing on financial frauds and scams, and also on related to payments on retail, cross-border payments, and remittances. Next slides, please. So I think I have a couple of minutes. I wanted to close with a few thoughts and a few stats on digital financial literacy, which, as I said, it's an essential part of the picture to ensure that these products really serve consumers and support their financial well-being. When using such products, the individual obviously needs to have the skills to understand the features of this product, the benefits and the risks. However, OECD research indicates that many people lack the knowledge, the skills, and the attitude to use digital financial services safely and effectively. So I'll highlight some of the results from the OECD INFI 2023 International Survey of Adult Financial Literacy. 39 countries participated to this survey, including 20 OECD members and including also 8 LAC countries, which you see listed here. Among adults in the 8 LAC countries that participated to the survey, digital financial literacy scores average 58 out of 100 points, which is slightly above the OECD average of 55. And while 94% reported not sharing PINs and passwords of their bank account with friends, only 65% recognized the risk of shopping online via public Wi-Fi, which is still above the OECD average of 49. Another stat is only 60% of individuals understood that the personal data shared online can be used for targeted commercial financial offers. And another findings that unsurprisingly, higher income and higher education levels correlate with stronger digital financial literacy. So I think I stop here. I have referenced in the presentation some of the reports that we published recently. And yeah, thank you for your attention.
Thank you very much, Tommaso. Thanks for also bringing to the discussion the issue or the link to digital financial literacy. I think it's a point that Christian also mentioned in his experience in Colombia. We have a few minutes left. I just want to take the opportunity to probably very quickly, and if you can also react quickly to some of these points. Just, Renato, you mentioned the issue of adding a cross-border functionality to PIX. No, that's a very interesting aspect that one usually talks about. How to take these solutions outside of the confines and the regulatory space and the policy space of national governments. What are the key challenges that you find in doing so?
Thanks, Luis, for this question. When we think about cross-border payments, it's useful to think about the exact use case. So we can think of remittances, we can think of retail payments, such as for tourists. We can think of international trade, and also we can think of capital flows. I think that international trade and capital flows, especially because of the volumes, they are well treated by the solutions that we have now. So the focus should be more on remittances and retail payments. And then when we think about, from the perspective of Brazil, which countries do you care the most about when we think about remittances and retail payments? And then, at least from the perspective of Brazil, remittances come mainly from the US, Europe, the UK, and Japan, because we have a large Japanese community here. And unfortunately, let's say, we need to have reciprocal interests. And the importance of these places to Brazil is not the same importance that Brazil has to these places. So if we follow the route of bilateral agreements, we find a lot of frictions, right? Because you need reciprocal choices to make them happen. So in order to solve this somewhat complex coordination problem, we're much more focusing on multilateral solutions. The BIS, for instance, has a multilateral platform that they are developing now with a focus on Asia, but that should go way broader, which is Nexus, which aims at interlinking fast payment systems. So we see that multilateral initiative as something that's very promising. But again, we need to see where our main partners go. So it's again a chicken and egg problem. If we see one of these, if we see the European Union or the US or the UK or Japan joining Nexus, Brazil has an extra reason to do the same. So at this point, I think the main difficulty, there's no technical difficulty on what pertains to technology and business case and the implementation, the more operational part. I think the challenges are surmountable. But what's actually challenging is putting all the actors moving together in the same direction.
Good. Thank you, Renato. And a final question to Sean, if you don't mind, Sean. Where is this literature going? The empirical literature that you mentioned, some aspects of it, but what are the promising avenues that scholars are looking at?
Great. Yeah. So I think I mentioned one is, I think now thinking towards other spillovers of these new payment technologies. So I mentioned a few studies on credit, but I think there's still a lot to do there, in particular, not only credit for consumers, but also for small businesses that are now receiving all these payment flows. So you can do a lot more cash flow based lending once you start observing that. You can also do more potentially kind of equity-based financing rather than debt-based financing for these small businesses if you have a reliable measure of their payment flows coming in. And then also, as you mentioned before, formality and taxes being a major friction as well. So I think on both sides, studying more how does informality affect adoption of fast payment systems, and then also the reverse, how does the adoption of fast payment systems increase tax compliance? So there are kind of two sides to that coin that I think is another direction that research is going.
Very good. Thank you. Christian, very quickly for you, you mentioned in your presentation the importance of, to go back to the point that Tommaso raised of financial literacy, and you mentioned efforts in this area. Could you tell us a bit more about it?
I lost you for a second.
Okay. So the issue that you mentioned in your presentation, the importance of financial literacy so that people can navigate these different systems, yes, and operate in that space. What's on your mind regarding this? What interventions would be the most interesting?
Well, we kind of hope that now that we're all together with the central bank, we can do a much better work as a country in this area, because we're going to be talking in the same language. So hopefully that will work for the better with this new system. But it's an effort that we all have to put our minds into as banks and non-banks and the government, because we have been doing it by ourselves. So hopefully this time it will do better.
Very good. Thank you so much. Our time is up. I just wanted to wrap this up by thanking Renato, Christian, Sean, Tommaso for joining us today. Thanking everybody who's also joined us from the audience. Great conversation, very interesting insights. I'm sure we'll come back to some of these issues in the future. Let me also thank Aida, Michael, and Hema for putting this together. And we'll see you next time on another edition of our webinar series. Thank you very much.
Thank you.